Landlords often say stuff like this: I am in property for the capital growth, or property always goes up in the long term. But does capital growth really make buy-to-let a great investment? If you research long-term returns, the stock market actually normally comes out better than buy-to-let. And property is normally heavily taxed, whereas stocks can be held in low tax wrappers such as pensions and ISAs. Many have made very good money in buy-to-let, but who are they? Those that borrow heavily. In general, when house price annual growth is higher than mortgage rates, increasing borrowing has an exponential effect on returns. Seems unlikely to work in the near term as of mid-2023. Those with an edge. It could be a skill in sourcing, renovating, tax, access to capital. It could be scale. People with an edge are always going to do well. Those that bought in the right area. It could be luck that you bought where you lived, or skill that you rode the waves in, say, London, or more recently Manchester. But most benefited from the golden years of buy-to-let. So we really need to understand how much capital growth is needed to make buy-to-let stack up. Before we look at the rent yield calculator capital growth section, it is worth understanding the calculation principles. The aim is to create an inflation-adjusted return from capital growth after all costs. To put it another way, how much is wealth forecast to change in real terms? The steps are as follows. 1. Calculate the net cost. This is the amount of cash the owner puts in. 2. Calculate the net proceeds. This is the amount of cash the owner gets out after all costs. 3. Remove growth taxes. In your own name, it's capital gains tax at 18% or 28%. In a company, it would be corporation tax at 19%, 26.5% or 25%, plus any taxes for extracting profits. 4. Deflate the increase by inflation. 5. Calculate a real cumulative annual growth rate. Excel has a function called RRI which does this. The model has a hard-coded assumption. Everything goes up in line with inflation, so expenses and property prices are assumed to move in tandem, except mortgage rates, which you are able to forecast separately. The model limitation is that if your house price rises faster than inflation, returns will be understated, but if house prices rise slower than inflation, then returns are overstated. If we now go to the capital growth section of rent yield calculator, at the top we'll see three KPIs. Net cash on cash, which we've already covered. We've then got capital growth return. So this is the real, after all expenses and cash, returns that you might expect from capital growth per annum. And then we've got total return, which is quite simply net cash on cash plus capital growth return. Below each number we have the variation against the benchmark. For total return, we can actually set the benchmark in this section. And the capital growth benchmark is implied from the total return and net cash on cash benchmarks. We can then have a look at borrowing. If our property is going up nicely, then if we increase borrowing, we're likely to increase returns. So for example, if we change from 60 to 75% borrowing, we will see returns increasing. Then we've got growth per annum. So this is the estimated growth per annum in the price of the property in question. So if we increase that, say for example, from 3% to 5%, we'll see a nice increase in returns. We then have buy-sell costs. These could vary from the low single digits if you had no stamp duty, but could go well into double digits. So for example, in Scotland, we have a 6% second home stamp duty surcharge. We then have hold years. So this is really all about the number of years that we're going to spread those costs over. And also capital gains tax rate. That will be affected in the calculation by the number of hold years. So the amount of tax we paid would be spread over the years. Now the CGT rate, we can set this for own name, but we could also set this if you happen to own the property in a company. We could adjust for that by setting an appropriate rate to cover corporation tax and any tax on withdrawals. And then we've got the benchmark, which is really the reference comparator, and we can see in green the comparison against the benchmark. The capital growth benchmark is actually implied from the difference between net cash on cash and total return benchmarks. What's also worth noting is if we take the borrowing down to 0%, we can then see a negative capital growth return. This is because we have a property going up with inflation, but we have a burden of the buying and selling costs, and also a very significant burden because of the higher growth from capital gains tax rate.